Hey everyone, welcome back to BullionIQ, your go-to spot for crypto insights, market updates, and everything you need to know about digital assets. I'm thrilled to have you here because today we're diving deep into some very exciting topics that could shape the crypto market in 2026. If you're someone who wants to stay ahead of the curve, especially with XRP, Bitcoin, and altcoins, you're in the right place. Before we jump in, make sure you're subscribed and hit that notification bell so you don't miss any of the important updates we bring to you daily. Now let's get straight to it. The first big question on everyone's mind is the 4-year cycle really dead? You've probably heard some experts talking about it. People like Lynn Alden and Cathie Wood have been sharing their perspectives on what could happen next in the crypto world. There's a lot of buzz, and while some are still bullish on the traditional 4-year Bitcoin cycle, others are starting to question whether it's even relevant anymore. So what does this 4-year cycle mean? Historically, Bitcoin has had predictable bull and bear phases roughly every 4 years. People have used it as a roadmap to time their buying and selling decisions. But now, with institutional money flowing in, the low supply growth of Bitcoin, and overall changes in market behavior, things are looking different. In the past, Bitcoin's annual supply increase was significant, and that drove big price swings. Today, the annual inflation rate of Bitcoin is under 1%, which is even lower than gold in percentage terms. That's a huge shift from the early days. Some analysts are saying that the psychology of the 4-year cycle might still influence the market a little, but it's not the main driver anymore. For example, when prices drop, public sentiment often becomes fearful, which historically has been a great opportunity to accumulate Bitcoin. Dollar cost averaging, or DCA, is a strategy that works no matter what, because instead of trying to perfectly time the market, you invest consistently over time. And right now, even with Bitcoin prices fluctuating, many believe it's an excellent time to lean in and accumulate, particularly if your focus is long-term. Here's the interesting part. While Bitcoin is in the spotlight, sentiment in the broader market has shifted. Enthusiasm is now spreading to areas like AI and gold, while public excitement around Bitcoin remains low. That might sound negative, but in reality, this is exactly when the smart investors step in. Buying during fear and uncertainty often sets you up for the biggest gains in the next cycle. History shows us that the greed periods are risky, while the fear periods present opportunity. Cathie Wood, for instance, highlights how Bitcoin is behaving more like a risk-on asset today. She mentions that Bitcoin has traditionally played different roles during crises like the European debt issues or regional bank stress, but now it's climbing another wall of worry instead of crashing. Institutions are stepping in, buying through retirement plans and ETFs, which is reducing volatility and potentially preventing the dramatic 70 to 90% drops that we saw in the past. This institutional entry is important because it sets up a fascinating comparison for investors. At a Bitcoin price of $100,000, one Bitcoin can be exchanged for roughly 45,000 XRP. The big question for investors now is, which holds more long-term value? Bitcoin has its track record, but XRP's potential is catching attention, especially because institutional buyers are looking at how much exposure they can get for the same amount of capital. That's why the upcoming XRP-focused index funds are so important. They represent new buying pressure and bring millions of dollars directly into XRP from large funds. Speaking of XRP, there's a massive story unfolding. Exchanges are running low on XRP supply for retail investors. Platforms like Coinbase and Robinhood are showing limited availability, meaning more XRP is being moved to cold storage or institutional wallets. Experts recommend keeping your XRP in secure wallets like Decent, Tangent, Arculus, or Trezor. This scarcity is pushing demand higher, and the smaller available supply could become a major factor driving XRP prices in 2026. Finally, I want to emphasize why 2026 might be a transformational year for crypto. With the combination of institutional adoption, ETF inflows, and scarcity of key assets like XRP, the market could see significant movement. And if you've been following BullionIQ, you know that my goal is to bring you real insights, actionable information, and analysis you can trust. This isn't just theory. We're looking at real data, trends, and developments that could shape the market over the next year and beyond. Let's focus on something that is generating a lot of excitement among institutional investors: XRP index funds. These funds are not just another investment vehicle. They are a major catalyst for demand in the XRP market. Essentially, when an index fund includes XRP as part of its portfolio, it guarantees consistent, large-scale buying of XRP directly from the open market. And we're seeing multiple new funds launching that will do just that, representing anywhere from 5% to almost 20% XRP in their total holdings. For example, the Wisdom Tree Index Fund is set to represent 19% of XRP. That's a massive allocation for a single crypto asset, and it signals strong institutional confidence. Similarly, the Bitwise Fund has a 5% share allocation in XRP out of a total fund size of $1.25 billion, which translates to roughly $64 million being actively purchased on the spot market. Think about that for a second. $64 million worth of XRP being bought up immediately. That's not speculation, that's real buying pressure. And unlike retail traders, institutions are in this for the long term, which stabilizes prices while scarcity grows. Other index funds like Franklin Templeton's ETF EZPZ are combining multiple assets such as Bitcoin, Ethereum, Solana, Doge, ADA, XLM, and Link. Some include XRP in their mix, which further increases buying pressure and introduces XRP to investors who might not have owned it previously. These funds are creating a situation where millions of XRP are being rerouted into institutional wallets rather than remaining available on exchanges. This is a key factor that most retail investors don't fully grasp yet. And that brings us to supply scarcity, which is now becoming a major story. Exchanges are running low on XRP for retail investors. Coinbase, for example, has almost nothing left for immediate retail purchases. Other exchanges are lowering liquidity, and platforms like Robinhood are restricting withdrawals. What does this mean for you? Simply put, if you're holding XRP on exchanges, you could be limiting your control over your assets. The recommendation from experts is to move your XRP to cold wallets. Options like Decent, Tangent, Arculus, and Trezor are all solid choices, with Decent being a popular recommendation for its simplicity and security. Why does scarcity matter so much? The answer is simple economics. When demand exceeds supply, prices rise. And right now, XRP is experiencing just that. In 1 month alone, from November 10th to December 10th, XRP reserves on exchanges fell by $1.32 billion. That is enormous, and it's happening fast. With more and more XRP moving off exchanges and into secure storage or institutional hands, the available supply for retail buyers is shrinking rapidly. This sets the stage for significant price movement when demand spikes. Now let's combine this with the staircase to Valhalla scenario, which is a term used in the XRP community to describe the projected accumulation and price breakout phases. Analysts have been tracking fractal patterns in XRP's price chart, showing repeated accumulation, reaccumulation, and now the potential for a major markup phase. There are two scenarios to consider. In one, XRP may temporarily dip below certain support levels, like $1.42, to fill the wick from October 2021. This could create short-term fear, but also an opportunity for smart accumulation. The second scenario is more bullish, where XRP holds above key accumulation support, like $1.90, and begins a steady climb toward resistance levels in preparation for a strong markup push. Either way, 2026 is shaping up to be highly favorable for XRP investors. Institutional involvement is also shifting the dynamics of volatility. Previously, Bitcoin and XRP could see dramatic swings, sometimes 70 to 90%. But now, with funds buying through retirement accounts, ETFs, and large-scale investment vehicles, we're likely to see smaller, steadier gains rather than extreme crashes. This is crucial because it reduces the risk of panic selling and allows investors to focus on long-term accumulation rather than short-term timing. It's important to understand that these inflows aren't just random. Index funds operate on rules-based systems. For example, if XRP represents 5% of a fund, the fund must maintain that allocation. That means continuous buying or rebalancing to meet allocation targets. This creates predictable, ongoing demand, which is a very bullish signal for price stability and growth. The combination of institutional money, ETF inflows, and retail scarcity is forming a perfect storm for XRP. With the upcoming wave of funds launching, coupled with exchange supply diminishing, the environment is set for XRP to potentially double-digit growth over the next 12 months. Investors who position themselves now, before this influx of buying pressure hits full force, could be in an incredibly strong position. Another interesting element is the psychological effect. As more investors and institutions accumulate XRP, retail buyers are observing scarcity and rising prices, which creates a feedback loop of FOMO, fear of missing out. This amplifies the buying pressure, further reducing available supply. It's a self-reinforcing cycle that often precedes significant bull runs. Finally, I want to touch on the fact that XRP is not just any altcoin, it's positioned for real-world utility. The asset isn't just speculative, it's designed to handle high-speed, low-cost settlements for financial institutions and cross-border transactions. This differentiates XRP from other cryptos that are mostly speculative. The combination of practical use cases, scarcity, and institutional adoption creates a unique opportunity that is hard to ignore. It's time to examine price action, market psychology, and what 2026 might hold for investors. Understanding these aspects is essential because while fundamentals like institutional inflows and supply scarcity drive long-term growth, price behavior and sentiment shape short-term opportunities and risks. Let's start with the concept of the staircase to Valhalla for XRP. This term has been circulating in the XRP community to describe a fractal pattern that is currently forming. Essentially, XRP has been in a cycle of accumulation, breakout, reaccumulation, and potential markup. Analysts have observed that the coin has consistently built support levels, then broken resistance, only to reaccumulate before the next surge. These patterns suggest that XRP is now at a decision point, either a temporary dip before resuming upward movement or steady accumulation, leading to a strong markup. Scenario 1 involves XRP filling a wick in the chart from October 2021, which could bring prices down to roughly $1.42. For some investors, this might feel like a correction or even fear-inducing, but here's the key insight. Market fear often creates opportunity. History shows us that when prices dip, those who accumulate strategically are positioned for the biggest gains when the markup phase begins. Scenario 2, the more bullish outlook, sees XRP holding above the $1.90 accumulation support. In this case, the coin builds momentum over a few weeks and targets vertical accumulation resistance. Either scenario, while different in short-term movement, points to strong potential gains in 2026. Now let's talk about market psychology. One of the most important lessons in crypto investing is to buy during fear and sell during greed. Currently, public sentiment around Bitcoin and XRP is muted. People are focused on AI, gold, or other emerging trends, leaving crypto undervalued in the eyes of retail investors. This is exactly the environment where savvy investors should lean in. Dollar cost averaging, as we discussed, works perfectly in such situations. By investing consistently during fear, you build a strong position for when sentiment shifts and prices rise. Institutional involvement also plays a psychological role. When large funds, ETFs, and index allocations buy XRP, it not only drives demand but signals legitimacy. Retail investors often follow institutions, and this can create a self-reinforcing cycle. Scarcity combined with institutional accumulation leads to FOMO, fear of missing out, which further drives buying pressure and reduces available supply on exchanges. This is why we're seeing XRP reserves drop dramatically. From November to December alone, $1.32 billion worth of XRP left exchanges. Such moves create momentum for upward price movement. Another factor influencing the 2026 market is the evolving role of Bitcoin. Many experts, including Cathie Wood, see Bitcoin behaving more like a risk-on asset today, climbing another wall of worry. And this shift is significant because Bitcoin historically drove market cycles. But with institutions diversifying into XRP and other altcoins, we could see altcoins like XRP outperform Bitcoin in relative growth. At high Bitcoin prices, institutions might prefer XRP for greater exposure per dollar invested, which adds another layer of demand pressure. The 2026 outlook also considers broader crypto trends. We're seeing ETF and index fund inflows across multiple assets, not just XRP. These funds create predictable buying pressure, meaning XRP is not solely reliant on retail speculation. When a fund must maintain a 5 to 20% allocation to XRP, it will continuously buy the asset to keep the allocation balanced. This creates a structural advantage for XRP, reducing extreme volatility while increasing long-term stability. Now let's discuss potential price levels for strategic planning. Analysts are monitoring key support and resistance levels. Support levels are crucial because they indicate where accumulation is likely occurring. Resistance levels mark potential points of consolidation before further upward movement. For XRP, the 1.42 mark represents a possible lower bound scenario, while 1.90 serves as vertical accumulation support. These levels help investors plan entries and gauge risk-reward ratios, which is essential for long-term success in volatile markets. Additionally, XRP's fundamental utility underpins these price predictions. XRP isn't just a speculative asset. It's designed to handle fast, low-cost cross-border settlements. Unlike stablecoins, which act as vehicles for transferring value, XRP is the engine that settles transactions. This real-world utility increases institutional interest and ensures that demand isn't purely speculative. Over time, as adoption grows, this functionality could drive higher price floors, making XRP resilient during broader market volatility. We also need to consider potential catalysts that could accelerate growth. Regulatory clarity, partnerships with major banks, and integration into payment networks are all fundamental triggers. Combined with the technical factors, scarcity, accumulation patterns, and ETF inflows, these catalysts could result in significant upside for 2026. Finally, let's touch on the human element. Investor psychology often amplifies market movements. Fear, greed, and FOMO are powerful forces. When assets like XRP have both fundamental support and scarcity-driven demand, retail investors often respond with urgency, especially as social media and crypto communities share news about price dips or rallies. The combination of rational fundamentals and emotional market drivers creates the perfect storm for rapid accumulation and potential bull runs. To sum up, the XRP price action in 2026 will likely be influenced by multiple overlapping factors: accumulation patterns, institutional inflows, exchange scarcity, market psychology, and fundamental utility. Whether XRP dips to fill wicks or steadily climbs above accumulation support, the broader trend points towards strong potential growth. Strategic accumulation during fear, understanding key support/resistance levels, and keeping assets in secure cold storage will be essential strategies for any investor looking to capitalize on this cycle. It's critical to understand how real-world adoption and integration into global finance can drive both demand and price. While speculation and trading patterns are important, XRP stands out because of its practical use cases, particularly in trade finance and cross-border settlements. This is where fundamentals meet utility, creating a strong foundation for long-term growth. One of the most fascinating developments involves Europe's plans for a digital euro. According to industry insiders, the European Union is engineering a next-generation financial infrastructure for trade. Unlike traditional methods that rely on slow, multi-day bank settlements, the digital euro is being designed to execute instant, event-driven transactions on-chain. For example, when a cargo ship arrives at a port, geodata and live video feeds can be recorded on a blockchain. When the shipment reaches storage, an RFID signature confirms delivery, and the digital euro moves automatically to the seller. No paperwork, no manual checks, no delays. Here's where XRP comes in. The EU's meeting with senior bankers and policymakers highlighted the need for a neutral settlement asset capable of bridging currencies and providing instant liquidity. XRP and the XRP ledger were specifically mentioned as the leading solution. Unlike stablecoins, which are simply vehicles for value transfer, XRP acts as the engine that settles transactions instantly. This positions XRP as a critical component of the next generation of European commerce, offering efficiency, reliability, and scalability. This kind of adoption is transformative. Traditional trade finance is slow and cumbersome, often resulting in delayed payments and trapped capital. For instance, even a 3-day delay in processing payments for monthly shipments can add up to 36 lost days annually. XRP's ability to provide instant settlement and liquidity removes these inefficiencies, allowing businesses to operate more smoothly and profitably. The economic impact is massive, and it's one of the main reasons institutions are taking XRP seriously. Beyond Europe, global adoption trends indicate that cross-border liquidity is becoming a priority. Banks, payment providers, and multinational companies are increasingly exploring blockchain solutions for faster, cheaper, and more reliable settlements. XRP's ledger is uniquely positioned to meet this demand. It provides the speed of settlement and liquidity that fiat rails cannot match, while maintaining regulatory compliance and transparency. This is why institutional interest in XRP continues to grow, and why large inflows from ETFs and index funds are likely to persist. Another factor driving adoption is the shrinking availability of XRP on exchanges. As more coins move into cold storage or institutional wallets, retail investors face limited supply. Exchanges like Coinbase and Robinhood have drastically reduced the XRP available for trading, reinforcing scarcity. When supply decreases while institutional demand increases, prices naturally respond. This combination of scarcity, real-world utility, and institutional adoption creates a powerful bullish narrative for XRP in 2026 and beyond. We also see XRP's role in trade finance as part of a larger global trend toward blockchain-based financial infrastructure. From supply chain verification to automated settlement, XRP is being positioned as a key component of next-generation commerce. As governments and large corporations experiment with blockchain settlement networks, XRP's relevance is increasing not just as an investment, but as a strategic financial tool. This is an important distinction. Many altcoins have speculative value but limited practical use. XRP, by contrast, has tangible utility and institutional backing. Its integration into real-world financial systems, particularly in trade finance and cross-border settlements, gives it an advantage over purely speculative cryptocurrencies. The combination of ETF inflows, institutional adoption, and strategic utility means that XRP isn't just participating in the market, it's shaping it. In addition, market psychology continues to play a role. As more investors learn about XRP's utility and the digital euro integration, awareness and confidence grow. Retail investors who previously ignored XRP are now entering the market, while institutions continue to accumulate strategically. The result is a self-reinforcing cycle of demand, scarcity, and adoption. Looking at the bigger picture, XRP is benefiting from multiple tailwinds simultaneously. Institutional inflows, ETF exposure, exchange scarcity, global adoption in trade finance, and strategic utility all point to a strong foundation for growth. The upcoming year could see XRP moving from the fringes of crypto speculation into mainstream adoption, both as a store of value and as a functional financial asset. It's time to focus on what's next for XRP and the broader crypto market and how investors can strategically position themselves for 2026. We've covered cycles, institutional inflows, exchange scarcity, and real-world utility. Now let's tie it all together with actionable insights. First, the market outlook. Based on the combination of institutional adoption, ETF inflows, scarcity on exchanges, and global integration of XRP into financial systems, 2026 looks very promising for XRP and altcoins in general. Historical patterns like the 4-year Bitcoin cycle may no longer be as relevant, but the market is now driven by fundamentals and real-world adoption rather than just speculation. For investors, this means the potential for sustained growth and reduced volatility compared to previous cycles. One key factor to watch is XRP scarcity on exchanges. As more coins move into cold storage and institutional wallets, the available supply for retail investors diminishes. From November to December alone, $1.32 billion worth of XRP left exchanges. This reduction in available supply, combined with growing demand from ETFs and funds, sets the stage for a potential supply-demand imbalance, which historically drives prices higher. For investors, the strategy is simple. Secure your XRP in cold wallets and be prepared for accumulation opportunities when prices dip. Recommended wallets include Decent, Tangent, Arculus, and Trezor, all of which provide security and ease of use. Another major trend is the role of ETFs in institutional inflows. Index funds allocating 5 to 19% of their portfolio to XRP are essentially guaranteeing continuous buying pressure. Funds like WisdomTree and Bitwise represent millions of dollars flowing directly into XRP, which provides structural support for price stability and growth. Unlike retail speculation, institutional buying is strategic and long-term, reducing the chance of sudden crashes and creating a more predictable market. The staircase to Valhalla concept also highlights potential price trajectories. Whether XRP dips to $1.42 to fill a wick or holds above $1.90 as vertical accumulation support, the key takeaway is that strategic accumulation during fear is a winning approach. Market psychology favors those who invest when sentiment is low. Retail investors observing institutional and ETF activity may experience FOMO, further accelerating demand and price growth. Global adoption is another driving force. Europe's digital euro initiative, built on XRP's ledger for cross-border settlements, demonstrates the coin's utility beyond speculation. Instant, event-driven payments, automated settlement, and programmable finance show that XRP is not just a store of value. It's a critical infrastructure asset for global finance. As other countries and corporations adopt similar blockchain-based settlement networks, XRP's role as a liquidity engine will grow, creating additional long-term demand. From a broader perspective, the 2026 market could see XRP achieving new heights in both value and adoption. Institutional interest, coupled with real-world utility and retail accumulation, creates a unique combination that rarely exists in the crypto space. Unlike other altcoins that rely heavily on hype, XRP has fundamentals, scarcity, and utility working together. This positions it not only for potential price appreciation, but also for widespread adoption in financial systems. So what should investors do? Here are some practical strategies. Accumulate strategically during dips. Key support levels like $1.42 and $1.90 represent opportunities to build positions while minimizing risk. Use cold wallets for security. As exchanges reduce liquidity and limit withdrawals, holding XRP securely off exchange ensures you maintain control over your assets. Stay informed about institutional trends. ETFs, index funds, and large-scale institutional inflows provide insight into where the market is headed. Following these trends helps you anticipate demand and plan accordingly. Focus on long-term utility. XRP is more than a speculative asset. Its role in global finance, trade settlements, and liquidity provision makes it a core asset for investors seeking exposure to blockchain-driven growth. Diversify but prioritize exposure. While Bitcoin and other altcoins remain relevant, XRP's combination of scarcity, institutional adoption, and utility makes it a priority for potential upside in 2026. Finally, let's talk about the broader crypto market context. Altcoins are likely to benefit from institutional flows and increased adoption, while Bitcoin continues to act as the backbone of the ecosystem. For XRP, the combination of structural buying, scarcity, and real-world adoption could make 2026 a defining year. Investors who understand the market dynamics, hold strategically, and leverage key opportunities are positioned to benefit significantly.